Hey folks, Dan Frio here with your market update for December 17th, 2024. So we're one day away from the Federal Reserve's meeting right through here. So Federal Reserve's meeting in one day, they're going to tell us what they're going to do. I know what they're going to do. Let me break it to you. The Federal Reserve is going to cut 25 basis points. Why? It's already built in. So what we're focusing on in this meeting is what's called the dot plot. If you don't know what the dot plot is, well, you need to know. And we're going to educate you on that today. So here's what's happening in today's news. We have this. So manufacturing numbers and servicing numbers came in yesterday. They didn't really have any reaction to the market. We have this morning so far, we have core retail sales and retail sales a little bit heftier than previously on the retail sales month over month. But now here's the data we're really focusing in on. The FOMC meeting. Who's the FOMC? Well, that's the Federal Reserve. They're going to come out today and tell us exactly what they're going to do. Here's the headlines that we're seeing all over the place. Fed is likely to cut rates, but some worry it might not be the right move. So we have former Fed official coming in telling us what she would do. She's on the bandwagon that she would not cut, but she's very interested on how the Federal Reserve is going to come in this time with a dot plot. So let me explain this to you real quick. Here's what a dot plot is. Every time the Federal Reserve meets, or not every time, well, four times a year when the Federal Reserve meets, they meet every 6 weeks, but every four times or quarterly, they come up and they create a dot plot. So anybody that sits on the Federal Reserve can put a dot where they expect the federal funds rate to be, well, this year in 2024, in 2025, and then in 2026. We're going to scrap 2026 because we don't even know precisely if they're going to cut in this last meeting. So here's what this is going to tell us. It's going to tell us where, they're expecting, the Federal Reserve is expecting rates to be in 2024 and especially in 2025. So what they do is they sit down at the meeting and they say, okay, here's where I'm expecting the rates, the federal funds rate to be by the end of 2025. And every person puts a little dot where it is. Okay, so let's analyze how they did this year. So this year in 2024, they had the dot plot and it's right through here and they expected it to be, well, this is between 4.25 and 4.5. There's a 25 basis point spread in here. So that where are we at right now? Well, right here. Here's the federal funds rate, 4.5 to 4.75. So let's go back over to the dot plot. So right now we would be up in this range through here. So if they cut one more time at the next meeting, bam, that's where it's going to be. So that's where most of them projected it to be by the end of 2024. Okay, so now here's the dilemma that we have. Are they going to keep all these rate cuts? Because if this is the consensus still, well, they're expecting the rates to come down. What? If you come down to here, let's just go to this part here. This is where the majority of the people were voting. They're going to say it's going to come in at 3.25 to 3.5. Well, that means it's going to have to drop quite a bit from where we are now, expecting today's rate cut. So there's a big spread still left in there. Is this spread going to continue? That's what we're mainly focusing in on because this will give us the projections of a lot of other interest rates going in the future. So that's one of the most important things that we're going to focus our attention on this week. And that's why this video this morning is basically just talking about this dot plot because people don't understand the importance of that. So right through here, here's where the Federal Reserve, this is the news that they're looking at. They look at inflation and unemployment and the GDP. How productive our economy is. The two main pieces they focus in on, they were created for actually two mandates. One was jobs, to maximize jobs, and the other was price stability, aka inflation. So inflation was coming down quite a bit in June of 2022. It was 7.2 in the PCE. It's come all the way down to almost 2.1. They want this at 2, then it went to 2.1, then it went to 2.2, and now we're at 2.3. So inflation's starting to turn a little bit, and they basically said that they had this tackled, but they want the unemployment rate to tick up a little bit. That would help the inflation piece because the more people that lose their jobs, well, they can't spend stuff. So then they can't spend. So then prices will come down and supply demand. That's what's happening. But the unemployment rate staying sticky at 4.2. They expected the Federal Reserve expected the unemployment rate to run to about 4.5, 4.6, 4.7, and it never got that high. And it's just basically staying steady right here at 4.2. And historically, it's not a bad number. Okay, so that's what we're looking at right now. So the markets, what they're going to do basically is right through here. The MBS market is basically flat right now. I'm expecting this to be because the Federal Reserve's coming out tomorrow, so why should bond traders really react to anything? So I'm expecting the market to be completely flat today on the bond market, especially in the equity markets. But this is the former Fed official I want you guys to hear, and she does bring up the dot plot, which is very interesting. So pay attention to what she has to say because this is big context in what we can expect tomorrow in tomorrow's Fed meeting. So let's take it away with former Fed official and CNBC.
Fed's two-day meeting kicking off today with a rate cut expected. Joining us right now, former Kansas City Fed President Esther George. Esther, it's great to see you. You've probably been hopefully listening to so much of the conversation, reading so many of the various articles opining on what Jay Powell should do. And it appears that there's this fear now that maybe inflation has not been dealt with and that maybe cutting rates right now is not the right move. What's your thought?
Yeah, well, good morning. I do think this is a time to be very cautious as you read the data. The committee, I think, has taken confidence in the fact that inflation has come down significantly. But of course, they're very clear about what their target is. And as we're watching inflation data come in, we're seeing that it's not continuing to decelerate in the same manner that it had earlier. So that, I think, is a reason to be cautious and to really think about how much of this easing of policy is required to keep the economy on track.
So if you were in the meeting, you would say no cut?
I think I'd be inclined to say no cut. Let's wait and see how the data comes in. Again, you know, Andrew, 25 basis points usually doesn't make or break where we are. But I do think it is a time to signal to markets and to the public that they have not taken their eye off the ball of inflation.
So I think, you know, all of the sort of signaling that's gone on even in the last couple of weeks has been around this idea that there would be a cut and maybe then there would be a pause, maybe even a lengthy pause. Does that strategy still make sense to you? Or I mean, if that were the case, if we woke up in the morning tomorrow afternoon and we heard, okay, they're cutting 25 basis points, but they then through language say, you know what, we think we're going to be paused for a long time after that because we know we haven't fully dealt with inflation. We're going to watch that, and we're also going to watch, you know, what the new incoming administration does. Would that temper things?
Well, I think that will be very important, of course. So I do expect that we will get a 25 basis point cut based on the communications we've heard so far. But remember, at this meeting is an important communication coming out, which are the dot plots, the summary of economic projections, which will give us clues about how the committee at large is thinking about the path ahead. So I do expect that we will see in there some adjustments in their inflation path. I think we'll see some adjustments in the Fed funds rate path to show that it will be a slower, more gradual downward move over the next year or so. And, you know, whether that is a pause, a skip, an extended period of leaving rates where they are, we'll watch for the communication coming out of the press conference tomorrow to get a better sense of that.
Esther, as they're putting that dot plot together, and this goes to the question of, you know, how do you predict what's going to happen under this new administration? How you think about tariffs?
This is the most important part about this because we know President-elect Trump's coming in. We know he's going to put tariffs on things. We don't know how the effect of that's going to be. So is it automatically going to increase prices on everything? Don't know. If it is, then yes, it will be inflationary. It most likely is going to be inflationary, but it'd be a long-term, you know, transaction. I'm for tariffs in certain situations. I won't get political, but you know, the uncertainty right now is the piece that's causing this confusion, especially in the bond markets at this time.
How you think about tax policy? How you think about all of these things that are going to converge in the year 2025 that may actually have a genuine economic impact? How the Fed should or shouldn't think about that as it tries to project forward?
Yeah, so I think the way I look at this right now, Andrew, is you have inflation running well above that 2% target, and it's shown to be sticky right now. Regardless of how precise one could be about potential policies coming forward in 2025, I think all of them so far suggest a caution light around this, whether it's tariffs, whether it's taxes, whether it's a fiscal policy and deficits in general. The reading I get is if you're a risk manager at this point, if you're thinking about what lies ahead and you've yet to achieve your 2% target, you will move carefully to make sure that you're not ceding the credibility that you want in terms of low and stable inflation. So I think it's a time to just be careful.
Perfect. That's a perfect analogy. And what that's saying is we don't know. And it's okay to say we don't know. Okay, so I know a lot of people out there, you're contending with, buying that first house. When should you buy it? Here, let me give you the best advice I can. If you can afford it in today's market, so you really want home ownership, you want to buy that house, you can afford it at today's payments, then okay. But you can't hope that, if rates would have been 4% or 3% or 5%, it would make it cheaper. Yes, it would. But over time, you might be able to refinance. So I'm coming out with several videos to show you how refinancing is easy. And a lot of those videos out there that say, if your home price drops a little bit, you can't refinance because of, your loan to value be out of whack or whatever. A lot of government programs don't even require an appraisal when you refinance. So I'm not saying, I don't care what's going on with home prices. If they come down a little bit, I don't know what's going to go on in 2025. I'm still working behind the scenes on my projections. I'm trying to come out with a great video so I can inform you guys what's most likely going to happen to house prices as well as interest rates. And we even have Fed officials sitting here not really knowing what's going to happen at this next meeting that's coming up tomorrow, let alone what's going to happen next year. So I'm trying to give you my honest opinions on what's going to happen behind this, and that's what I'm working really diligently behind the scenes to give you my forecast for 2025 to kind of put you at ease. But that's my report for this morning. If you're out there and you're looking, here's what I do. My name is Dan Frio. What do I do for a living? Well, I do this. I'm a mortgage loan officer. I don't do videos. I do videos just because I want people to be informed on what they're doing, what they're getting into if they're looking to buy their first house, maybe buy an investment property, and how you can refinance in certain ways and certain scenarios that really can benefit you. And is it as daunting as, when you bought that house? In most cases, no. And in many cases, you don't even need to re-verify your income, nor do you need to re-verify or get a new appraisal done. So that's how some refinances work that easily. So don't be scared that you're going to be stuck in a rate at 7% for the life of, you're in that house. And if you can afford that payment, God bless you. So my goal here is to help everybody out there down this path. If you're looking to buy that first house, buy that first investment property, maybe does it make sense to refinance, do a debt consolidation, things like that, we would love to help you. So visit us at therateupdate.com. Here's our website. We've cleaned up the top a little bit up through there. A lot of people were getting confused of what was what and things like that. So here's what I'll ask you to do is if you're ready to put in that application, just click the Apply Now button. If you're not, either do one of two things. Click here to schedule a consultation with me, Alan, or David, or you're going to scroll right down through here and the same people is going to be answering the phone. So if you give us a call at 844-775-5626 or you email, you're going to get me, Alan, or David on that call. Or if you email me, that'll be me down through here. So if you want to email me directly, my email is dan@therateupdate.com. So I will be back today. I promise you with the closing bell. I am back from my trip and I'll be back here I don't have any plans to go anywhere anytime soon. So you're stuck with me every day, at least 2 times a day. So thanks for watching, folks. God bless. Have a fantastic afternoon. If you need our help, please, you know where to find us. Take care. See you later. Bye-bye.